For this episode we will discuss the most common balance sheet accounts in the chart of accounts of a retail business, like a grocery store. A chart of accounts is a list of the account titles that a company has identified and opted to use in recording transactions in its general ledger. A company has the option to tailor-fit its chart of accounts to best suit its requirements, including adding accounts as needed. The number of account titles in the chart of accounts depends on the size and complexity of the business operations. This means that smaller entities have fewer account titles, like 30 accounts or so, while bigger or large companies have more account titles ranging from hundreds to thousands depending on their size. Some large companies use account numbers with 5 or more digits in length, with the first digit representing account classification and the others a division, department, section within the department, activity, etc. The sequence in which the account titles appear in the chart of accounts are as follows. 1. The balance sheet or permanent accounts comes first, with asset accounts on top, followed by liabilities, then capital or owner's equity. Next is the income statement accounts, which are operating revenues followed by operating expenses, then non-operating revenues and gains, and non-operating expenses and losses, if any. The balance sheet accounts in the chart of accounts of a retail business are as follows. 1. Cash on hand. These are funds within the confines of the company, usually representing collections of revenues that are not yet deposited. This is usually held in trust by the cashier or any designated personnel. 2. Cash in bank. These are funds deposited in the company's bank accounts. These usually comprise of collections of revenues already deposited, proceeds of bank loans, direct remittances in payment of customers' accounts, direct deposits of owners' additional capital or partners' investment share to the company, etc. 3. Petty cash fund. This is the standby funds of the company for business-related requirements or activities that are of small or petty amounts. 4. Accounts receivable. These are receivables from customers arising from revenues or sales on credit which are not yet collected. 5. Other receivables. These comprise of other accounts due to or collectible by the company. An example is merchandise taken by the owner for personal use or consumption, which he or she will later on pay to the business. 6. Allowance for doubtful accounts. This is an estimate of the amount of accounts receivable that are not expected to be collectible. The actual uncollected amount may vary from the estimate, depending on the payment behavior of customers, or their capacity to pay. 7. Merchandise inventory. For trading business or those that are into buying and selling, this represents the goods for sale. 8. Office equipment. Any equipment used in the office of the business, like laptop or desktop, cell phone, etc., may be included in this account. 9. Store equipment. Any equipment used in the store, such as but not limited to cash register, air condition, freezer, chiller, digital weighing scale, etc., may be included in this account. 10. Furniture and fixtures. Furniture account is comprised of movables such as tables, desk, chairs and file cabinets that are not permanently attached to the building structure. While fixtures are those that are non-movable in nature and are attached to the building structure, such as display cabinets, and building partition, which are used in the business. For small entities, furniture, fixtures, and equipment are usually taken up as a single account and abbreviated under FF&E account. 11. Accumulated depreciation. This refers to the sum of all depreciation expenses recorded on a tangible asset to a specific date. Depreciation expense represents how much of a tangible asset's value has been used up, and this is computed using several methods. But for this discussion, we shall use the straight line method, which is allocating or dividing the cost of the asset by its useful life. An example of a tangible asset subject to depreciation is office equipment. 12. Leasehold improvement. This refers to the improvements on rented property, such as but not limited to repairs and repainting, which benefits the business for at least more than one accounting period. A tenant may want to invest in leasehold improvements in order to improve the characteristics of store space to its specific preference. In accounting, a leasehold improvement is considered an asset of the tenant if the tenant paid for it. 13. Accumulated amortization. This refers to the sum of all amortization expenses recorded on an intangible asset to a specific date. Amortization expense represents how much of an intangible asset's value has been used up, and this is computed using several methods. But for this discussion, we shall use the straight line method, which is allocating or dividing the cost of the intangible asset by its useful life or life expectancy. 14. Accounts payable. This is a liability account that is used to record amounts due to suppliers for goods or services received that have not yet been paid. 15. Notes payable. This is a liability account where a maker-borrower records a written promise known as promissory note, to repay the lender at a specified date, with interest. 16. Capital. For purposes of our discussion, the term capital refers to assets and money invested or brought into the business by the owner or partners for the purpose of generating revenues or income. 17. Retained earnings. This refers to the portion of the profits generated by the business that are not distributed as dividends to owners but instead are reserved for business purposes such as but not limited to the following: reinvestment back into the business, to purchase additional goods for sale to continue the business, and for paying debt obligations.